we are now finally in the largest bubble ever known in history. This is larger than John Law. It is larger than South Sea bubble. This is the big one. It is larger than the dot-com bubble. I mean, when this bursts, there's nothing, absolutely nothing any central bank can do about it. Because by reducing interest rates this time, they just collapse their currencies. That is really how serious this situation is. And I think that we're likely to see this develop in 2025. The only way out of it is just get the hell out of credit. And if you're going to get the hell out of credit, what do you go to? Well, the only thing is real money, which is gold, and to a lesser extent, silver.
The decades since have underscored just how destructive U.S. monetary and fiscal policies have been, as the dollar has lost significant purchasing power. In 1971, the dollar was officially valued at 1/35th ounce of gold, whereas today, that same dollar purchases less than 1/1900 ounce of gold. That's a 98% loss of purchasing power in a little over 50 years. The flip side of that, however, is that the value of gold is far higher today, over 5,000% higher. That highlights that the more value the dollar loses, the more value gold gains. In this video, Alasdair Macleod criticizes the misconception that higher yields make gold less attractive. He explains that gold's primary role is to hedge against credit and fiat currency risks, especially the dollar. Gold prices rose on Thursday, driven by safe haven demand in light trading after the Christmas holiday, as markets awaited signals on the U.S. economy under the incoming Trump administration and the Federal Reserve's interest rate strategy for 2025, Reuters reported. While reflecting on the market, Macleod argues that central banks misuse interest rates, which should stabilize currencies but not manage economies. Under a gold standard, interest rates were adjusted to protect gold reserves by making currencies more attractive, not to manipulate the economy. The gold market continues to struggle overall, as the interest rates in America continue to be very strong. At this point, the gold market is getting ready to test an area that must hold for strength to return. Liquidity is also a major issue at the moment. Macleod's assessment warns that central banks' habit of lowering rates to counter credit bubbles has led to the largest financial bubble in history. He cautions that its collapse will render central banks powerless, as further rate cuts will only devalue fiat currencies. Now we present the clips of Alasdair Macleod's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Now, again, this is where market commentators get the relationship between gold and yields completely wrong. They think that if you get a higher yield, it makes gold less attractive because gold yields 0 or 1% or, on a lease rate or whatever. But what they ignore is the whole purpose of gold is actually to hedge out of credit. And what we're looking at in terms of credit is fiat currencies, and particularly in this case, the dollar. So if the value of the dollar starts going down in terms of its purchasing power, then gold will appear to rise. And that's basically what we face. I think that there's a huge error, if you like, in central bank thinking that the purpose of interest rates is to manage economic outcomes. No, it is not. I mean, if you go back to the days of gold standards, it was there basically to manage your gold reserves. In other words, if the gold reserves started going out of the door, you had to raise interest rates to make your currency, which was a gold substitute, attractive to the arbitrageurs to get the gold flowing back into your reserves. That's actually the true role of interest rates, is to stabilize the currency, not to manage the economy. And of course, so all central banks are doing completely the wrong thing. This is now basically what's happened is that by using interest rates to try and manage economic outcomes, every time there's been a credit bubble, the response from central banks has been to reduce interest rates sharply, to take the pressure off malinvestments, off the zombies, if you like, off banks which may be over-leveraged for those conditions and face substantial, loan problems, if you like, bad debts. Take pressure off markets. I mean, ever since Greenspan, he was talking about you've got to keep the stock market bubbling, take the pressure off the stock market. So you've had bubble after bubble after bubble, and we are now finally in the largest bubble ever known in history. This is larger than John Law. It is larger than South Sea bubble. This is the big one. It is larger than the dot-com bubble. And I remember the human psychology in the dot-com bubble was exactly the same as, you read accounts of, the Mississippi bubble and the South Sea bubble and the tulip mania and all these bubbles. I mean, it was up there with the extremes. When this bursts, it is going. I mean, there's nothing, absolutely nothing, any central bank can do about it, because by reducing interest rates this time, they just collapse their currencies. That is really how serious this situation is. And I think that we're likely to see this develop in 2025. The only way out of it is just get the hell out of credit. And if you're going to get the hell out of credit, what do you go to? Well, the only thing is real money, which is gold, and to a lesser extent, silver.
Regarding the silver market, Alasdair Macleod underscores its persistent undervaluation and 4 years of supply deficits. Governments, such as India's, subsidize solar initiatives, further straining silver supplies as they tap into Western markets. Macleod highlights that manufacturers holding silver are unlikely to sell during price rises, intensifying market shortages and preventing silver prices from soaring. Silver's performance next year will be driven by tightening supply and accelerating industrial demand, with Federal Reserve policy and gold's movements playing supporting roles. While silver trades near $29.62, traders assess whether ongoing supply deficits and rising usage can sustain higher prices, or if dollar strength will pressure the market. The current silver market is experiencing what industry experts describe as a perfect storm of supply constraints meeting accelerating demand. The global silver market has operated under a supply deficit for nearly 4 consecutive years, creating fundamental support for prices that extend beyond typical market cycles. This persistent imbalance represents a structural shift in the market rather than a temporary phenomenon. Let's get back to the interview.
Silver has always been undervalued. I mean, talk to the bunker hunts back in the late 70s, early 80s. They tried to corner the market. They obviously came up with exactly the same conclusion. It's an interesting one because silver has gone through quite a number of changes. There was a time when its major market was celluloid film, photography, whatever. But since then, things have changed hugely. And there is no doubt that demand for silver is enormous. Now, I think the question is not so much implying, should we be bored of this story, but actually look at what the Silver Institute's numbers show, that it has been in supply deficit for the last 4 years. And the drawdown on it has been from what they call investment funds. Now, investment funds, all very well, but a lot of them aren't really investment funds. It's a sort of balance figure, which is an assessment, if you like, by the Silver Institute, to make the numbers, on the sort of supply side and the demand side and the deficit. Okay, we've got a deficit. So what we've got to do is we've got to pencil in a number somewhere which will cover it. So you can see that to some extent the number is made up. But I mean, after 4 years, and not only that, but I mean, this demand is not going to go away. And one of the other things, actually, going back to COMEX deliveries on the silver side, is that the Indian government decided, it needed to do something nice and, ESG friendly, whatever. Stop criticism from G20 fellow members. So they said, right, okay, what we'll do is we will subsidize the production of photovoltaic cells. Okay, so what happens is that the big Indian conglomerates then set up manufacturing facilities like I think Reliance Industries, which is one of the big ones, sort of looking to produce something like, 20 gigawatts of photovoltaic cell, output. Yeah, sort of however many units that is. I mean, just huge. Again, carpeting in India with these things. But where do they get the silver? They haven't got any help. Good idea. I tell you what, we can go and raid the markets, the Western markets. So, as I say, 1,324 tons have disappeared on standing for delivery. Now, I don't think it's actually necessarily gone out of the vaults yet, but I would suspect that, this is all part and parcel of the shortage of silver around. And, again, if you're a manufacturer of photovoltaic cells or whatever, and you have been prescient enough to accumulate a stock of silver, which, you must have, okay. Assuming you've been prescient enough to do that, then when you see the price rise, are you going to try and sell some to push the price down a little bit? Are you hell's like you're going to hang on to your silver, so tight it's not going to go anywhere near the markets? Now, these balances are basically what the Silver Institute tell us are the swing factor, which has stopped silver prices going to the moon.
As long as inflation continues, the value of each dollar will continue to decrease. The long-term trend for gold prices is one of steady increases. No wonder so many Americans today are trying to buy gold. According to Goldman Sachs research, gold is forecast to climb higher than expected as central banks in emerging markets have ramped up purchases. As we approach 2025, how prepared are you to navigate the challenges of collapsing credit systems and the shifting dynamics in precious metals markets? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.